What's up everyone, my name is Coleman, and in this video, I'm going to be going over what is happening to Wish stock and why they are down over 25% since Thursday. I'm going to go over exactly what is scaring investors away, my thoughts on the company, and what I'm personally doing, since this is a company I've covered before and seemed interesting to me at the time. With that said, let's waste no time and get right into it. So what is happening to Wish stock and why is the company down so much? Well, on Thursday afternoon, Wish posted their much anticipated second quarter earnings. These results disappointed investors, and when trading opened the next day, the stock was down around 25%. Now there are a few reasons for Friday's sell-off, but for starters, Wish posted a double miss, so they missed on EPS and revenue. The company posted a negative EPS of 18 cents a share, which missed analyst projections of negative 13 cents a share. For revenue, Wish posted second quarter revenue of $656 million, which was down 6% compared to 2020's second quarter revenue of $701 million. Additionally, this quarter's revenue missed analyst expectations by a little more than 10%. Analysts were expecting Wish to post revenue of $723 million, but instead they posted revenue of $656 million. So they had a pretty significant revenue miss. They said they weren't pleased by this, but they did face some tough comps compared to the second quarter of 2020 when there was increased online shopping and less competition from physical retail. Now digging a little deeper into their numbers, their revenue was really hurt by their core marketplace segment, which is where they generate fees when a user purchases a merchant's product, and this area fell by 32%. Over half of this decline came from North America, where revenue dropped from $264 million to $149 million. Much of this was driven by a decline in user activity and active buyers, as they had a 13% drop in app installs and a 15% drop in average time spent on the platform. Wish was particularly disappointed by this, and they expected an increase in user retention now that they have reliable logistics, but instead it declined. The good news is that logistics is continuing to improve, and their logistics revenue actually increased 126% this quarter, so that's nice to see, even though there have been a lot of negatives so far. Now another reason why there's a big sell-off was that the company reported that they experienced an increase in advertising costs, which hurt their business. Wish said that as a result of Apple's recent privacy changes, more advertisers are shifting their spend to Android devices, creating more competition for a limited supply of impressions. This drove up competition for advertising bids and increased advertising costs, which restrained Wish's ability to reach more users. Because of this, their CEO, Peter Solcheski, wrote in a letter to their shareholders that they have to cut back on digital advertising, and new buyer conversion will be minimal as they focus on maintaining the retention of their existing users in the near term. Additionally, Wish expects their marketplace revenue to decline even further in the second half of 2021 due to the reduction of digital advertising. To add to this, Wish did not provide any quarterly revenue outlook and said they will focus squarely on execution and efficient expense management. So this increase in advertising costs really screwed up the business for at least the short term and caused a lot of uncertainty for investors. To address these issues, the company said that they will make some changes in the way they operate. In the coming quarters, Wish said that they will strengthen the quality of their products and add more recognizable brand names, optimize the app, and develop a more engaging shopping experience. They don't expect these new initiatives to contribute to positive year-over-year results before the second half of 2022 though, meaning that in the short term, there will be some uncertainty in whether these strategies will work, which investors don't like. To add to this pain, multiple analysts and firms immediately came out and downgraded the stock. On August 13th, Coleman, JP Morgan, Bank of America, Oppenheimer, and William Blair all downgraded the company. JP Morgan actually gave them a double downgrade, which is rare, and cut their rating from overweight to underweight, while cutting their price target from $17 to $5. Additionally, 3 other firms lowered their price targets, and many of the price targets were dropped by 30% or more. So for people that put a ton of weight into analyst predictions and price targets, this was just more bad news that contributed to the sell-off. Between Wish's earnings miss increased advertising costs, which changed their business plan, and analyst downgrades, these were a few of the main reasons that contributed to the stock's sell-off since Thursday. So what are my thoughts, and what am I doing with this company after all of this news? Well, the earnings were obviously not very good, but I'm not going to beat a dead horse, and I'd like to dive a little deeper into the underlying business and some things that I'm monitoring. First, as far as the good, like I mentioned in my last video on Wish, I like the industry they operate in, how they're trying to target value-conscious customers, and their growing logistics business, which seems like a good opportunity. They also don't trade at a crazy valuation at just 1.6 times sales, and they have a good balance sheet with $1.4 billion in cash and only $45 million in debt. That said, my main concern with Wish has been whether they'll still be able to capture market share if they back off sales and marketing or S&M spending. And I think we were able to get some more information on that in the past few days. Just a few months ago, Wish was spending 67% of their revenue on S&M, and every year their S&M spending was more than their gross profit. Even with all of that S&M spending, their number of active buyers remained steady around 64 million. Yes, they were adding more users, but this wasn't turning into more buyers. This was a concern for me because even with all of this spending, they were struggling to attract more buyers, and I was wondering how they'd continue to grow if they backed off of S&M spending, which had been their plan. Fortunately, we were able to get a little more clarity around this in their 10Q, conference call, and shareholder letter. Wish said that their quarter-to-date revenue is down roughly 40% in July, and that's primarily driven by a lower buyer count driven from lower ad spend. So the decline in S&M spending is already hurting their growth, and their number of buyers are declining. They said going through the rest of the quarter, we expect that to decline further as we only started pulling back ad spend part of the way through July. So this concern about S&M spending has not gone away from me, and it may have even gotten worse as they're actually experiencing negative growth after slowing their ad spending, and I was hoping to see the opposite happen. I do see a potential opportunity here though, and that has to do with their new strategy to add more name brand products, which is a new area that I'm keeping an eye on. As I mentioned earlier, Wish said that they're going to start adding more high-quality, globally recognizable brands. I actually think this is interesting because they've typically focused on selling unbranded, generic products, which is okay, but when it comes down to it, a lot of people like name brand products. If Wish is able to add more high-quality, name brand products for affordable prices, there could be an opportunity to turn into an online version of TJ Maxx. This could also help convert their users into buyers while also building their platform's reputation, since a lot of people currently associate Wish to cheap, scammy products. Personally, I'm not a Wish buyer, but if they were able to add affordable name brand products, this would probably be a site that I'd buy from, since it would have the feeling of an online TJ Maxx, which is a store that I love. I'm sure there would be a lot of people who would feel the same way as well, which is why I'll be watching this to see if they'll be able to add more name brands and increase their active buyers by doing this. Now, I'm not sure how likely it is that they'll be able to make this transition, but given their already large audience, there might be an opportunity here. That said, I would like to see a little more progress being made in this area, and so far, the results from backing off of S&M spending haven't been what I was hoping for. So I'm still not buying this company right now, but I still do think they're interesting, so I'm going to continue paying attention to them and see how their business progresses. And if any of my concerns go away, I may reevaluate my decision. With that said, if you liked the video and found it helpful, don't forget to hit the like button, and if you want to see more videos like this one, please subscribe down below and hit the notification bell. Thank you so much for watching, and I'll see you in the next one.